In this lesson, we're going to talk about Fibonacci as a trading indicator. And I tell you, as trading indicators go, this is really hotly debated in the trading world. Some people love it, absolutely love it, really believe in it, embrace it, use it all the time. Others like, I don't like this at all, and they don't use it at all, and they just think it's kind of a little bit, more mystical. And some people think it's got mystical qualities in a good way because it's based on, Fibonacci math. So all of our mathematicians out there watching are saying, "Yay, more math, Fibonacci." And people also, it tends to be, can be a little bit more of an advanced indicator, by the way. The understanding how it works is not too bad, but then applying it can be a little bit more tricky. And as we go through the lesson, you'll see how we do that, and you can decide for yourself whether that's easy or hard for you. But the big idea with Fibonacci is you're trying to identify pullbacks or retracements. You're trying to see these different support levels and resistance levels. You're trying to, see what might be going on in terms of, mathematically what might be going on in terms of a, volatility or market sentiment type indicator. And the trading platform will automatically calculate all these things for you as far as the actual, Fibonacci and how you use it. The platform will calculate it for you. So you have to do any math or calculations, and then you take what it calculates and you overlay that on top of the chart. So that's where it can get a little tricky, is where you place it on the chart, and we'll demonstrate that here for you coming up. So first off, it's actually pretty instructive to understand, well, what is Fibonacci? What is it? Where did it come from? What's the big idea behind that? So at its heart, Fibonacci is basically math. It's a mathematical sequence of numbers. As the sequence of numbers described by the mathematician Leonardo Pisano Bigolio, I might got it wrong, I don't know. But Fibonacci is a sequence of numbers that he discovered and came up with, and it's a very well-established idea in mathematics. Basically what you do is you start with a 0 and 1, and then you add each number in the sequence to the previous number to get the next number. It's a sequence of numbers. So if you look at the example here, this is the Fibonacci sequence. It's 0 and 1 is 1, and then 1 and 1 is 2, and 2 and 1 is 3, and 3 and 2 is 5, and so on as you keep going on out into infinity. So that's how it works. It's a mathematical sequence of numbers, kind of interesting that way. But how does that work for trading securities? Like, okay, that's nice. Well, if you look at your Fibonacci, if you take how it's applied in trading, actually, again, you don't have to calculate this math, but it's good to understand the underlying why, because these numbers that you're going to see highlighted in the yellow are going to be important to us when we start actually using in trading. But basically with Fibonacci, if you take any two adjacent numbers in the sequence and divide the lower number by the higher number, and you keep going, and you'll keep going, and you'll count this calculation, and you'll approach the ratio of 61.8, is where it approaches. So an example, 5 divided by 8, two adjacent numbers, 5 and 8 is 0.625, 8 is next to 13, 0.615, and everything starts approaching this 61.8 as kind of an accepted average for Fibonacci. And then you do the same, but instead of using the two adjacent numbers, you use two further along the sequence, and they get close to 38.2. So it would be like, let's say instead of 5 and 8, it would be like, say, 5 and 13. And the same thing with 3 further along, it would be 5 and 21, for example, as you go further along. And these are at 38.2% and 23.6%. So those numbers are actually very important because they're going to show us when we do our Fibonacci overlay. These are important numbers that we're going to use for making trading decisions on. So in trading, the key numbers are 0, 76.4, 61.8, 50, and these are all percentages, 50%, 38.2, 23.6, and 100%. And the levels, these are the key numbers that they use, and we're going to talk about why they were chosen in just a moment here. But the levels are calculated in relation to the vertical distance between the high and the low, looking at it as a percentage basis. So it's a 0 to 100% is the full trading range of, let's say, a security. And then there's percentages based on between 0 and 100%. Again, these are not prices. It's not 61.8 rupees or dollars or whatever it might be, euros, or 38.2 or anything like that. It's a percentage. 61.8% would be an example of a number in our trading range as using Fibonacci. Now, first off, you might look at that and say to yourself, well, wait a minute. Not all of them are truly Fibonacci. I saw some of them were, but not all of them were truly Fibonacci. So let's talk about that for a second. So the 0 and the 100% represent the high and the low price, the high and the low price. So we need that to kind of use that from a trading aspect, so even though it's not truly Fibonacci. 50% you sometimes see in there, sometimes it's out of there, sometimes it's in there depending on your trading platform, but 50% is based on another theory, actually it's a Dow theory, that says a trend has a good chance of continuing once there has been at least a 50% retracement in that. There's a 50% turns around, you can see that the trend will tend to continue in that, and once that retracement of 50% has happened. So that's where you see the 50%. I'll talk about that more in a second here. And then 76.4%, not Fibonacci, but that's basically taking 100% and subtracting a Fibonacci number, 23.6. And that kind of developed over time by Fibonacci trading supporters. They wanted that number, and there is another indicator, another level to look at. So that's where they kind of came in. So you have true Fibonacci, and then trading over time has kind of developed to add a little bit more to it to make it more of a complete indicator is the idea behind it. So the idea is, in the theory behind trading Fibonacci, is if a security has shot up over a period of time and is starting to pull back, or starting to pull back, there will be support at the Fibonacci levels, below that high. So if it's gone up and it's starting to come back, you have these different Fibonacci levels that we just talked about, and then as it approaches them, there's a chance it's going to rebound and go back there. Likewise, if a stock has fallen and bounces back, starts to bounce back up, you'd see resistance at the Fibonacci levels, as far as seeing resistance to going above a Fibonacci level. So it's looking at going above and below, looking like at those support and resistance lines. So using the concept of support and resistance lines, you're basically adding that into Fibonacci levels. So we'll take a look about how that's actually applied here in these graphs here, so you can kind of see that a little bit better in action.